PE ratio. PE ratio.
PE ratio. PE ratio.
P ratio. What is the PE? P for parent. E for elephant.
P ratio is a bad investing metric. And basically, lots of investors are using it, and lots of investors are also advocating for the use of it without really knowing the dangers with using it as a measure of whether you should invest or not. So we're going to see the situations in which P ratio acts as a good metric for investment, and two, when it might be a really deadly, bad metric for investing. And then we're going to look at the real good measures you want to look at before you buy a company or you buy shares in a company. So what is P ratio? Let's start with that. What is it? Basically, it's the number of years when you recoup your investment. What do we mean? Let's say you bought an investment for 1,000,000 shillings, and that investment is giving you 200,000 every year. You will take 5 years in order to recoup your investment. You put in 1,000,000 shillings, you'll get back your 1,000,000 shillings after 1 year. So basically, that 1,000,000 over 200,000 equals 5. 5 is your PE ratio, and it can be for any investment that you take. So be it farming, or let's say you've planted cabbages and it costs 200,000 for you to plant, to do everything. Everything costs you 200,000. Then in the year you get a profit of 50,000. So that 50,000, you compare it with the 200,000 that you put in. It's 4 times, right? 200,000 divided by 50,000, that's 4. 4 becomes your PE ratio. So basically, that's what we are speaking about. It's how many years does it take you to recoup your initial investment? And a lot of people are using it as the only metric to invest. The lower the P ratio, the better an investment, or the quicker an investment returns your money, right? And when it comes to the stock market, there is a critical thing that happens, in that the value, or the market value of your business, is not the same as the actual value of your business. What I mean is this: sometimes you can have a business that is doing well, it's making revenues, it's paying its workers, it's making profits, but then you find that when you go to the stock market, the prices are really crashed. They're really bad. And what does that essentially do? Have to do with P ratio. It's that when the business is good and its profit are good, and the market price is low, you find that the P ratio is also low. But that's sometimes the market is high, right? And you find that the P ratio is also high without anything having changed in the business. So those two things are usually unrelated, but it's also very critical to understand that it might be of benefit when the market price is low, let's say after a crash or something, and you buy a good business. So in that situation, a P ratio would be really good. But sometimes a P ratio might be very, very misleading. Let's say you have a company, let's say it was the cabbage business, and you also have another company, and they have the same P ratio. That is, they give you back your money after 4 years, right? So P ratio is 4. But one business is growing, let's say at 50% in profits per year, while the other company isn't growing. those two companies have the same PE ratio, yes, but they are very, very, very different. Because yes, you pay the same price for them this year, but by next year, one of them will be giving you more profit than the other. So by next year, looking at how much you're getting, then it means that the first company that is growing a lot was actually cheaper relative to the company that is not growing. So just looking at the P ratio doesn't tell you the future profitability of the company. So that's why it's like really important to not use this as the only metric that you are using for investment. That's a big mistake. Another situation is when we have a company that's reinvesting its dividends. Let's say a company worked hard, it got profits this year, but then instead of like giving the shareholders the profits, it does something. It takes the profit and then uses it to expand the business. So maybe it buys more machines, it makes the system more automated, it expands the stuff or the range of products. So in that way, you find that yes, a pay ratio might be looking healthy, but it doesn't really consider whether the company used that money to give to the shareholders or it used it for expanding the business, which is called capital expenditure. Basically, in simple terms, that's just you got your profits, instead of giving back to the owners or the shareholders, use that money to expand the business. So a pay ratio in that situation doesn't give you how much you're going to profit from the company. Other times you find that a company got lucky and this year it made a lot of profit, right? So its P ratio is basically very low for the year. So maybe it got lucky and there was an increased there was euphoria in the markets and people like bought and bought and bought. But the euphoria might not be persistent. The demand might not be persistent. In that case, it will have a low P ratio, but come next year, the P ratio will shoot up because the earnings will reduce. So an important thing is consider the profits over the years. How much did it make last year? How much did it make the other year? Does demand change depending on time? Is the company dealing with a commodity? Like let's say a company like Capture Tea, it sells tea, and sometimes the price of tea just like shoots up. Was it such an year? I think these are questions you want to ask yourself. That sometimes commodity prices will change and will go up and down. Sometimes you might ignore a company with a high PE ratio, while the case is that it just had a bad year. So it's like really important to consider a company over a longer time and also consider whether the demand is sustainable over the long term, as well as growth, as well as capital expenditure, as we just explained. So the other thing I touched on was on what happens during market bubbles and stock crashes. So that's also like a really important thing. So I think it's not just a matter of looking at one number and then deciding everything on that number. It's like really, really important to consider a variety of few simple things like revenue, how much. And if you're liking the video right now, you can press that like button. So we want to look at a variety of a small number of factors over a number of years, right? We want to look at the revenue. We want to look at the profits per year. We want to look at the economic conditions and what is the company actually doing? Because if you don't understand the product, how it's made, who are the customers, then you might as well be gambling, because it's as simple as that. You want to really understand what kind of product the company is dealing in. You also want to understand who are the buyers. Are they inside the country or outside the country? And if they're outside the country, where is the exchange rate going, right? Because if you have a larger market outside the country, and let's say you're receiving dollars from them, then the Kenya shilling becoming stronger is a good thing for the company. The Kenya shilling becoming weaker, it's a bad thing for the company. So, like, all these things, you want to take all these things into consideration. They're not like money, like revenue, profit. Is the company in debt? How long will it take to pay back that debt? Is that debt, is it owned by foreigners or by Kenyans? What are the economic conditions in the country? So those things are like important to look at. So P/E ratio, don't ignore that, because it's like really important, right? You don't want to buy a company that will take like 50 years to recoup your investment, right? Because, and one good thing about Kenyan companies is that the P/E ratios are really, really low. If you compare US companies and Kenyan companies, you're more likely to get your money back very quickly in Kenyan companies. So that's one of the advantages of being in Kenya. So P/E ratio gives you a very shorthand way of valuing a company. At the same time, you want to consider growth, revenue, profits, cash flow, the amount of money after reinvestment back into the company. And then after doing all those things, then you are in a good position to make better investments.